Hi there, I'm Cathy Zhang. I simplify doing business in China for foreign companies. Have you ever wondered why some businesses pay more VAT than others in China? Or why VAT compliance can feel so complicated at first? In this video, I will break down everything you need to know about value-added tax, VAT, in China, including how it works, different types of taxpayers, and practical tips to stay compliant and optimize costs. What is VAT? Value-added tax, or VAT, is one of the most important taxes for any company selling goods or services in China. It's a tax on sales, but unlike some countries, China classifies companies as either small-scale taxpayers or general taxpayers. Small-scale taxpayers pay a flat 3% VAT but cannot deduct VAT paid on purchases. General taxpayers pay between 6% and 13%, depending on whether they sell goods or services. But they can deduct input VAT, meaning they can offset VAT paid on purchases against the VAT collected from customers. This deduction is key for cost control, especially for companies that deal with suppliers and imports. How VAT works in practice. Let's make it concrete. Imagine your company imports components from abroad and sell finished products in China. As a general VAT taxpayer, you can deduct the VAT you've already paid on imported components from the VAT you collect from your customers. This prevents double taxation and ensures your pricing stays competitive. Small-scale taxpayers, on the other hand, cannot claim this deduction, which can make VAT management more expensive and less flexible. Also, if your business exports goods or services, China often allows a zero VAT rate, which is a huge advantage for foreign companies selling internationally. VAT invoicing and compliance. VAT compliance in China relies heavily on special VAT invoices called Fapiaos. For general VAT taxpayers, issuing special Fapiaos allows your customers to claim input VAT themselves. Proper invoice management is essential to avoid penalties and ensure deductions are valid. For small-scale taxpayers, you usually issue simplified Fapiaos, but you won't provide input VAT credit to your clients. Monthly or quarterly reporting is required, depending on your taxpayer type, and everything is submitted electronically through Chinese Tax Bureau portal. A common mistake foreign companies make is misclassifying invoices or missing the filing deadlines, which can result in fines, interest, or blocked transactions. Here are 3 practical tips. First, determine your taxpayer type carefully. Your choice affects VAT rates, deductibility, and compliance obligations. Second, keep accurate and detailed records. Invoices, contracts, and import documents must all match your VAT filings. Third, consider professional support. Working with a local accounting firm can prevent errors and help you claim VAT deductions correctly. VAT may seem complex at first, but once you understand the rules and set up the right processes, it becomes a tool for cost management, not just a compliance requirement. If you found this helpful, don't forget to like, subscribe, and hit the bell for more insights about doing business in China. And tell me in the comments, what's your biggest challenge with VAT compliance so far?